Good afternoon, everyone. Thank you for joining the webinar this afternoon. My name is Andy Medler. I'm the Senior Account Manager for MoneyCorp Corporate Partnerships in the UK. We're also joined this afternoon by Andy Daly, who is our Enterprise Sales and Partnerships Director based out in the US. So today's subject is help for businesses with international interests during the global shutdown. And we are MoneyCorp, and we deliver the Chamber Foreign Exchange. We're the accredited provider for the British Chamber of Commerce. For anyone who's on the call today who doesn't know who MoneyCorp are, I just thought we'd cover off a few kind of high-level points as to who we are as a business. We've been around since 1979. We're the oldest and longest established non-bank FX provider within the UK marketplace. We've traded over 14,000 corporate clients last year and traded just over 35 billion of currency. We are, as I said earlier, the preferred partner for the British Chamber of Commerce. We work very closely with the ICAEW, the Telegraph, City AM, Everton Football Club, and lots of other large organisations across the UK. One of the added security measures with MoneyCorp is that all funds are held in client segregated bank accounts, and at no point are client funds held within MoneyCorp's own accounts. As a business, we are a UK business with our head office being in London. We have local offices across the UK in Coventry, Leeds and Edinburgh. We have global presence across the continent, well, across the world in general. If Andy wants to kind of just cover off maybe our US offices, Andy?
Yes, good morning and good afternoon to everyone. Thanks for joining us. So yes, here in the US, we have our head office in Providence, Rhode Island, which is where the vast majority of people sit in terms of servicing our clients. But we then have offices in California, in LA and San Francisco, and we're quite good presence here on the East Coast, where I sit in Washington DC, with offices obviously in DC, New York, some people in Boston, incidentally, and in Florida, where we have quite a large team which traditionally have serviced British expat clients who are retirees and lucky enough to own property in the sunny climate of Florida. Thanks, Andy.
Oh, sorry, people. I was on mute then. For people who didn't see that, so we are MoneyCorp. We are the fundamentals of MoneyCorp is we are just a foreign exchange company. We save companies on the cost of their foreign exchange and payments, giving expert guidance on hedging and risk strategy with ongoing support from a dedicated account manager perspective. The beauty of MoneyCorp is we are just a foreign exchange company. We are able to offer that higher level of support around foreign exchange in an ever-changing environment now where a lot of banks don't give that level of support. In terms of what has affected the markets around COVID, as we all know, we've seen huge impacts on personal levels, from a corporate level, globally across the world, as the effect on the COVID pandemic over the last 6 weeks or so. Just wanted to cover off a few kind of very high-level points that are kind of very, very interesting. So the world trade is expected to fall between 13 and 32% in 2020. As the COVID-19 pandemic disrupts normal economic activity and life around the world. Nearly all regions will suffer double-digit declines in trade volumes in 2020, with exports from North America and Asia hit the hardest. The estimates of the year impact on UK GDP range between -4% to -8% versus a projected 1% growth pre-COVID-19. So I think though that stat alone shows the sheer impact that COVID has had. The OBR has published an illustrative scenario suggesting a larger fall of 13% in GDP in 2020, but the IMF forecast for the UK was a decline of 6.5%. Estimated that the budget deficit could rise to between 8 to 12% of GDP in 2021, compared to 10% in 2009-10 after the global financial crisis. The worst hit sector will be the transport, hotels and food service, which could see their annual output in 2020 down by anything from 15 to 40%. The fiscal policy set out by the UK government and the Chancellor is the UK government will do whatever it takes to support the UK economy. To date, 140,000 companies have applied for the furlough scheme, affecting nearly 9 million workers across the UK, and the cost of this is expected to rise to £42 billion. This is all part of an immediate fiscal impulse package of £100 billion to support the UK economy. A further £200 billion of quantitative easing has been announced as part of the Bank of England's emergency measures. The independent fiscal watchdog estimate the budget deficit could soar to £273 billion in 2021, the largest single deficit since the Second World War.
Okay, thank you, Andy. Unfortunately, it's no better from a US perspective. So if you'll bear with me, I'll try and get through this as quickly as possible. So the US economy contracted by 4.8% in Q1, ending a record run of consecutive growth going back to 2014. But perhaps more worryingly is the outlook for the coming quarter, where the economy is expected to contract by up to 30% in the 3 months to June. We are also experiencing unprecedented levels of jobless claims. And since mid-March, in fact, over 30 million Americans have applied for unemployment, which is absolutely staggering. And, in the 17 years I'm doing this, I have nothing to point towards in terms of understanding what this will mean for us going forward. Obviously, in terms of US GDP, again, a very bleak outlook with a fall of around 3 to 8% predicted, which obviously prior to COVID, the US economy had been continuing to show considerable growth and a projection of 2% for 2020 pre-COVID. Interestingly, the IMF are forecasting a fall of around 6% for 2020. To keep the bad news coming, it's expected that the budget deficit here in the US could reach as high as 18% in 2020, which compares with a fall of around a deficit of around 8% in 2010 after the global financial crisis. So, the numbers here are staggering, and, there's huge concern right across the US economy. Again, similar to the UK, the hardest hit will be those in transport, hotels, food and service. And it's likely that we will see a contraction of anywhere between 20 and 40% in those industries. Notably, Mr. Warren Buffett has pulled out of all his airline stocks in recent days, which is, again, a signal of how difficult trading is likely to be in that particular sector. Again, the US government have stepped up to try and combat this, huge challenge with announcing $3 trillion of stimulus. That's with a T, which is just unheard of. And this is part of federal emergency measures, which include direct payment to families, which again is unheard of. But perhaps more worrying for small business at present is the initial $349 billion SBA PPP scheme, which was designed to provide liquidity to companies and protect employment numbers. Unfortunately, this was heavily and in fact oversubscribed very rapidly, leaving up to 80% of applicants without funding. Now, there is further schemes that are due, but it just shows you the challenges that the US economy and SME and large organizations are now facing. Interestingly, we're moving towards 31 states reopening as pressure to restart the economy grows, and we will just have to watch and see the impact in terms of output going forward. So taking a look at the next slide, we just want to show you the impact of this type of event on the foreign exchange markets. So what we're looking at here is the sterling to dollar market. On the left, you have a 12-month chart. Interestingly, all of us will have heard a lot about Brexit over the last number of years, and over the past 12 months, sterling dollar rates have moved from low to high in a range of 15.2%. That is pretty big, but it's not massively beyond normal trading, which would be north of 10%. But on the right, you will see the impact of COVID and the news-related flows over the past 4 weeks, in this instance, the last 6 weeks. So in the last 6 weeks, we've seen sterling dollar move by 12.5% from low to high. And obviously for any business trying to manage foreign exchange exposures, these are serious moves, and in many cases will have left companies in a very difficult situation in contracts they may have negotiated but not had a hedge in place. Again, to note Warren Buffett here, it's a quote that comes to mind when I look at moves like this, and he's famous for saying, "It's only when the tide goes out you see who has been swimming naked." And I think a lot of companies will have felt particularly naked in this environment, going forward they will have to, if not previous to this, consider how they do manage foreign exchange going forward. So we move to the next chart, which again, it's a similar type of exercise here, looking at the impact of sterling euro. Again, over 12-month period, we've seen a 12.6% move. Again, a lot of this driven by Brexit related news flow. But again, the last 6 weeks have been particularly volatile, and an 8.5% move that companies are having to deal with in terms of their own profitability or their ability to achieve margin on a particular transaction. And finally, the impact for euro dollar here, which is obviously most relevant to our US audience. And again, similar type of pattern emerging here. So look, what is clear is FX markets are extremely volatile at present. Companies are now more than ever looking to see how they can manage the numbers and the impact of these moves within their own business.
Thanks, Andy. So as we've seen on the last 3 slides, we have seen huge volatility as a result of the COVID impact. What we thought would be interesting is to show what the true cost of that to a business is. Charts are all well and good and looking at where markets have moved from and to, but when we put what I call meat on the bones, I think it really shows a true picture. If we use an example of a business importing $500,000 of goods over the last 6 weeks into the UK, as the last few slides seen, we've seen a high of 130.66 against a low of 114.35. Over that 6-week period, that's a sterling increase of £54,500 in a 6-week period. That's a huge amount of money to any corporate to swallow if they didn't have any element of hedging in place, to have to kind of swallow that up out of surplus cash supplies they may have had. And the same looking at a sterling euro perspective, 115.05 down to 105. Losing the slides here, bear with me. That's a cost increase of £40,100. Huge impact, I say, to the bottom line. One note to kind of put on here as well is this is obviously based on a company importing. Obviously, for exporting businesses, there's obviously been an opportunity where they've been able to obviously enhance from a UK perspective, there's the sterling input back into the business, so that through all the doom and gloom of COVID, so to speak, there has been an opportunity for some businesses, if they hadn't hedged, to be able to ascertain some additional revenue to their bottom lines. Andy, you're on mute.
Apologies, folks. So each day, trillions of dollars are transacted globally in the FX markets. This is split across spot transactions, which is effectively the purchase or sale of a currency for immediate delivery, and the rest comprised of forward contracts and currency options, which companies utilize to mitigate or manage risk in a manner that fits their underlying risk appetite. And many companies will also use what we call a market order, which is effectively a means by which you can target a rate in the market. And effectively, for instance, if sterling dollar was trading at 125 this morning, but you wanted to achieve a rate of 128, you can effectively put this order in the market and it will sit with your provider on a 24/7 basis until this level is achieved, or you cancel the order. And this is could be a particularly useful way of having some skin in the game and getting access to moves in the market, which, given the current volatility, is a good way to achieve what you're trying to get in terms of rate. So what is a spot contract? Let's talk a little bit more in detail here. So a spot contract effectively means you trade on the rate of a day. Okay, for instance, going back to the previous example that Andy has talked through there, if we were to agree the importation of, say, $500,000 worth of goods with a supplier, over the past 4 weeks, we've obviously seen the currency trade as high as sterling dollar, that is, trade as high as 130.66 and as low as 114.35. If you were lucky enough to have bought the currency at 130.66, or in fact, if that was where the spot market was trading on the day you set the invoice, fantastic. You will have done that at a cost of 382,672, and great, you've had a really, really good outcome. Unfortunately, if for those who didn't protect themselves in this environment and may have had to settle an invoice when the market was at the lower end, the cost could have risen as high as 437,254. So huge swing in terms of the cost of that $500,000 worth of goods. So the spot market is absolutely a point in time, and if you are agreeing to purchase goods, if you're agreeing to bring in some product today, but going to settle an invoice at 30 or 60 days time, it's time to consider whether dealing at spot is the most appropriate way to be doing business. So what is a forward contract? It's very simply, it's a way of locking in a rate today, which you will utilize in the future, and thereby protecting yourself from unfavorable moves in the market over a period of time. A simple comparison would be to look at how we all assess our own mortgage liabilities. And a lot of us will favor a fixed rate mortgage over the floating or variable rate that you could also use. And effectively, this allows us to know our costs into the future and plan accordingly. So very similar to that, a forward contract allows you to know with certainty the price at which, or the rate at which you're going to purchase your currency or sell your currency into the future, thereby bringing certainty into your business. So how does a forward contract? Sorry, is this my slide? Sorry, apologies. So how does a forward contract work? If the rate, effectively what we're looking at here, again, using the same numbers, forward contract is about ensuring you do not lose money on your agreed prices with your customers or suppliers. And effectively, companies can use a forward contract to lock in a rate as far out as 36 months. Now, worth noting, most companies will not hedge further than 12 months, but in certain industries or contracts or deals, it may be needed to lock in that rate for a further period.
So what is a market order? As Andy touched on earlier, it's a way of targeting a specific rate in the currency markets. It's a great way of being able to just ascertain a rate that you want to achieve. If we look at today's rate as an example, let's say dollar was at 124. As a business, if you're wanting to make a payment of $45,000 by the end of May, you could place an order in the market at, let's say, $1.26. What that then means is between now and the end of May, if the market hits 126 at any point in time, we'll execute that deal for you as a business. The beauty of that is, obviously, we all have our standard working days where currently we're all working from home predominantly. But, generally you're in the office, you're watching the markets, you go home. The markets still continue to trade 24 hours a day. With a market order, the market stays live in the markets 24 hours a day. So what that means is you often get a spike in the middle of the night. So it could be that you put an order in today, next Tuesday at 3 a.m. British time, something happens on a global market scale, you get a spike in the market. When you come back into the office the following day at 8:30, 9 o'clock, you'd get an email to say at 3 o'clock this morning, the market spiked at 126. We've placed that order for you. The benefit of that is, let's say, by being asleep, the market has been watched and the deal has been executed for you. If you hadn't have put that in place, you would have obviously been notified that the market would have spiked, but you would have missed out on that trade. And sometimes you get it where the markets go up and then they actually retract even further than they were the previous day. So it's a really good way of looking to target a specific rate. If the market doesn't hit the 126 by the end of May, you would simply trade at spot. And that comes back to what we were saying earlier. You're at the mercy of the market. So the market might have been at 124, but now spot's at 123. You have to trade at 123. A stop loss can also be entered into the market. So for argument's sake, you could put a stop loss in at 120. Now, we saw sterling dollar fall down to 115 a couple of weeks back, or just below 115. What that would have meant if at that time, if an order had been put in at 120, as the markets fell away down to that sub 115 mark, the deal would have been executed at $1.20. So how do corporates typically trade? Generally, corporates have one banking partner. So we've used the example of Barclays Bank here. We're not picking on any banking particularly. Barclays are one of our banking partners. You're limited as a corporate by the buying power because it's one on one. Through working with someone like moneycorp, we have access to 17 liquidity providers on a global basis. What that actually means is you've almost got 17 different banks working for you on your behalf. So when you get your rate from moneycorp, we go to the 17 different liquidity providers, we get the best rate and we pass that rate on to you. So when we buy the currency, we might have bought it from Deutsche Bank, we might have bought it from JP Morgan, we might have bought it from Goldman Sachs. You as a client won't know who we've bought that currency for. What us to do is get that currency at a better rate through to our buying power through our liquidity providers.
So just to kind of pick up some final thoughts, it's clear we're living through in a very uncertain time in terms of the current global pandemic. And it's very difficult to assess the impact on the global economy and, which economic areas will emerge quicker and what the impact will be on underlying currencies. Obviously, Europe are slightly ahead of the US in terms of opening up. And if the opening up can be productive and without a second wave of illness, then hopefully Europe will be on the road to recovery. Often people are talking about a V-shaped recovery, which if this does take place, it's good news for everybody, and it certainly may lead to the European currencies beginning to win some big moves against the dollar. Obviously, the dollar currently benefiting from safe haven status. The good news within all of this is there are hedging solutions available to protect your bottom line, the most commonly used being the forward contract. And that's a very simple product that provides certainty with regards to the cost associated with purchasing a good or service, or allowing one to lock in the value of international sales in their local currency. Another consideration as we move very much into a cost reduction cycle is to consider, are you paying too much for your international or FX payments? As a partner with the chambers, moneycorp in most instances, I believe, and you have to have a caveat to everything, but we offer free FX payments within this group. So again, it could be a significant way to address cost as we move into the challenging cycle ahead. And part of the ethos of moneycorp is always to sit down with companies offering free rate comparisons so that you can assess the ability of moneycorp to add value, and more importantly, we will get stuck in and provide an FX audit for you guys as well. allowing you to kind of assess where you're at in terms of your current risk management in terms of foreign exchange, and devising ways that you can establish a policy, relatively simple policy, that allows you to match your FX risk management with your appetite for risk within the business. So thank you all. Andy and I would like to invite questions at this stage, and happy to clarify any of the points made within the presentation.
Can see some questions are coming through, Andy. So I got one first question here is for both as a corporate business, have we missed the boat as volatility will be less as we move forward? Thank you for the question on that one. Yes, no, it is the kind of, I think, immediate response on that one. We have seen a huge volatility over the last 6 weeks as an effect of COVID on the markets. But I think as we move forward, cash will be, really more important to businesses than maybe previously. I think hedging solutions in terms of looking at have we missed the boat will be even more important. And personally, I think what we will find is as we come out of this kind of close down period, however we want to term it, is where previously businesses might have said, well, we're going to hedge $1 million over the next 12 months. What they'll probably end up doing is more and more on a contract by contract basis. So they've got a 30-day payment, they'll cover off that for $30,000. They've then got another one for $15,000, they'll cover off that for $15,000. And the importance of that is the fact that, where previously you would invoice it and say, right, I'm going to get 30,000 sterling back, in 30 days, 60 days time, where previously you might say, well, actually, I've only got 29,800 back due to an adverse market movement. Well, actually, due to cash being so important as we come out of it and the type measures in place, it will be more important to lock that rate down and know that I'm not going to lose that £200 like I've done previously. I'm going to use that hedging to protect 100% of my costs, because that's how you've signed the deal with your particular supplier.
Okay, just looking at the next question. How does MoneyCorp compare with going straight to a discount broker? Okay, so look, appreciating that we compete with banks, other brokers and service providers of all type, size. Look, MoneyCorp, like all banks, well, like most tier one banks certainly, are dealing foreign exchange in what's called the interbank market. So we have never have any issues competing on price. And in in a lot of cases where you're looking to develop a new relationship, price is absolutely the kind of key metric that you need to hit on the first instance. That said, what clients of MoneyCorp will highlight is the level of service, technology, our payment capabilities, which I like to think of MoneyCorp as a payment institution that make revenue or make money from the foreign exchange piece. So for a lot of companies, certainty around delivering optimized payments is as important as maybe the foreign exchange rate. And equally, what we've always been strong at and consistent at is taking the time to understand our customers and help them to create a sensible foreign exchange policy that addresses risk, obviously ensures that you're dealing at highly competitive rates, but also optimizing the other bits that include payments and settlement of everything that needs to happen to make this work in the way you need it to as a business. So yes, we compete on price every day of the week, and we're always comfortable to do so. But I think the experience of MoneyCorp is much broader than that, and our our offering is certainly compelling from other aspects also.
To what extent does the activity in the money market affect the rate rather than timing of the value of the deal? I mean, the markets move every 3 seconds, so there are lots of factors that affect the way the foreign exchange markets move. So, I mean, in terms of timing of the deal, it's very, very hard to say when the best time would be to buy currency. It's hard to say first thing in the morning, last thing at night, because news comes out and markets react accordingly. And again, in the current times, things are so volatile. We get data feeds all the time from banks and liquidity providers and news outlets. Sometimes you would expect them, certain elements of news to come out, a market would move one way, but in reality, sometimes that news comes out and markets react completely differently to how we would expect the markets to move, and that was what makes the foreign exchange markets very, very hard to second guess. Andy, is there anything you want to add to that?
Yeah, I would just jump in on that. Obviously, if we're working with the moneycorp, we will have access to industry professionals who are eyes and ears on the market every day, and hopefully can help you guide through movements and news that will likely have an impact, and help you to get timing as right as possible. But it is important for us to highlight that trying to, inverted commas, beat the market is a fool's errand. What you want to achieve is a framework whereby you're protecting your business from severe and unfavorable moves, which ultimately protects margin and reduces risk. And at MoneyCorp, we work with businesses of all sizes to devise and implement an FX risk management policy, which will help you to achieve that into the future. So, unfortunately, none of us have a crystal ball. Very often we do have a sense of which events in any given week will lead to movements. But again, look, as Andy mentioned, sometimes markets are irrational, or the news flow that can impact foreign exchange is almost everything and anything. So it is just very, very difficult to predict. But again, working with someone who will proactively help you as a client, I think these are the steps that businesses need and should take to try and get the best in terms of timing, rate, etc.
Do you want to pick up the final question, Andy?
So in terms of what tools are people using, we touched briefly on the forward contract. So effectively, you're talking somewhere between 70 to 80% of hedging takes the form of a forward contract. So I briefly touched on it earlier, but a forward contract effectively is locking in a rate based on the current market and adjusted for interest rates for a point in time in the future. And effectively what you achieve then is certainty as to the cost or value of your currency going forward. Important to note that, look, using a forward contract, you're eliminating risk, which is both upside and downside. So, there is an opportunity cost with a forward, in that if the rate were to improve, you are locked in and would not benefit from that move. But that said, very simple product and very flexible product, meaning you can eliminate risk. And, going back to the example, if I agree a deal with someone today to purchase 500,000 euros worth of product, do I really want to be leaving myself exposed to movements in the spot market for a period of 60 or 90 days? Going back to the charts we showed previously, that could hit me with a 10% loss in currency terms. So, very simply, but when most businesses are agreeing a contract, they will effectively go into the market and book a forward contract, which effectively protects them from moves in the spot market for the period of whatever timeline it is to making the payment. So very simply put, most companies use a forward contracts. It's a simple product, time tested, very clear and simple to understand and utilize. But there is other tools that people can and do use, and you're looking at FX options in this case, and moving to a more complicated risk management approach. But again, moneycorp do and will sit down with clients and run through all the tools available, and many clients will utilize dealing at spot, forwards and options, so kind of combination of the three. So the importance is to look at your business, your appetite for risk, understand the products available, and work with someone like moneycorp, preferably moneycorp, to manage the risk in a sensible fashion.
We just had one final question coming about what is the cost of locking in. Is it a fixed fee based upon again amounts, and what is the cost of the forward contract? Thank you for the question. So in regards to the cost of a forward contract, worst case scenario, we ask for a 5% deposit on the sterling notional amount that you're booking. So, you know, if you booked 100,000, your sterling deposit would be 5%. Best case scenario, there is no cost, so it's zero deposit for locking in that currency for the duration of the contract. Now, we look at that from we take a credit risk as a business, so we work with our credit team. So we would speak to our credit team, say, client wants to look to lock in $1 million over 12 months, whatever the notional amounts may be. We will then look at that from a business perspective. We just base it off company's house profile, and we then say, right, it's either no deposit or a 5% deposit. It might be somewhere in between. It might be a 3% deposit. In terms of the rate that is charged, that is all down to currency and also duration, because obviously it's based on what we call an interest rate variables. Interest rates are always always changing, especially in the current climate. So I say it's very, very hard to say it's a particular rate or a particular percentage. If you take out a contract for 3 months or for 18 months, obviously the difference in the time duration will obviously have a bearing on the actual rate that you're going to achieve. But you know, things like that, obviously, we can discuss directly with you as clients. So hopefully that would have cleared that one up as well.
And again, just a final note to add to that bit. So in the current climate, where companies will be struggling in terms of appropriate levels of credit, and we will have seen this going back to the global financial crisis, you know, banks will be pulling back on forward dealing lines. They won't be renewing lines, and you know, credit will be much more difficult to access. So again, having a provider like moneycorp alongside your bank will, you know, typically add additional headroom to those facilities. And in my experience, especially in an environment like this, moneycorp will be much more competitive than a typical bank when it comes to forward hedging prices as well. Obviously, booking a forward contract comes with a credit, an element of credit risk for the provider. And again, moneycorp being a leaner and more streamlined operation, it allows us to provide credit lines to those who need it, and those who don't maybe have the balance sheet. We can provide the cash backed or the margin backed approach. But just suffice to mention that spot dealing is very transparent, but important to assess the ability of someone like moneycorp to save your business money in terms of the hedging you do as well. Banks will be pretty aggressive in terms of the margin they look for on forward dealing. So thank you very much.
Obviously, mine and Andy's details are on the screen. So if you do have any questions, and you want to come to us directly, please feel free to contact us via email or the relevant phone numbers. And thank you for watching today.
Thank you.